So here are some of the key lessons that he has always reinforced. And he wrote it in this letter again this year. So the first thing to always remember is that he keeps saying that Charlie Munger and I, we are not stock pickers. We don't pick stocks. We are business pickers. And that's one thing many people don't understand, that the way Buffett approaches the stock market is different from everyone else. In a sense that he keeps saying that when you buy a share of stock, you're not buying a lottery ticket that you're predicting will go up now and you're hoping won't go down in the next few months or 1 year. When he buys a stock, in his mind, he's buying a piece of an underlying business. So always remember that. When you buy a share of stock, you're becoming the part owner of a business. If the business does well, in other words, if the business makes more and more money over time, you will do very well as a shareholder. So, is there a difference between thinking about stocks and businesses? Yes, and that's why when I train my students, I like to use the word businesses instead of stocks because it gives you a very different perspective. See, many people, when they buy a stock, what happens? And the price goes up the next day, they feel happy, or they feel smart, and they feel that it was successful. But if the stock goes down the next day, or the next week, or next month, they feel lousy. They feel that, oh, it's a lousy investment. But that's not how Buffett looks at it. To him, when he buys a share of stock, he's buying a business. So he judges his performance not based on a short-term price movement, but he judges his performance based on the performance of the underlying business. So in other words, as long as the underlying business is making more money, is increasing its free cash flow, its economic moat is strengthening, is making more and more sales, to him, that's a great investment, regardless of where the share price goes in the short term. In fact, there are many times when he buys a great company that is undervalued, and after he buys it, the share price goes down another 10-20%, he's not upset. In fact, he's happy. He says, great. Why? Because it's a great company, the company's making more money, and the price is going down. I get a chance to buy more shares at a lower price. Now, very few people think like that, and that's what makes him different. So you got to train yourself to feel happy when the share price goes down in the short term, because it means you can buy more shares as long as you know you picked a great company. So it all comes down to the fact that you only invest in great companies, in businesses with long-lasting, favorable economic characteristics. So what does that mean? It means you only buy companies that have a sustainable competitive advantage, that have got a wide economic moat, that is able to fend off competition over the long run, that are run by trustworthy managers. And that's the main difference, right? Where, remember, many people make the mistake where they buy a stock just because it is cheap. Remember, cheap crap is still crap. For example, in my opinion, Intel looks cheap right now. But would I buy Intel no matter how cheap it is? No, I won't. Because to me, I don't think it's a great business. I think that they've lost their competitive advantage. And if you listen to what a CEO said recently, I don't think it's very trustworthy. Because in January, he said that Intel, we're going to maintain our dividend. That's what he said, right? But in 3 weeks, they cut the dividend by 65%. So either he's an idiot, he didn't know that his own company is going to cut the dividend, or he was lying. So either way, it's an incompetent or not a trustworthy manager, right? So you got to be really careful about that. But if you buy a great company, share price goes down, that's a good thing. That's not a bad thing, all right? So one advantage of buying publicly traded companies is that it's an auction market, that it becomes easy to buy pieces of wonderful businesses at wonderful prices, which means it's easy to buy great companies at crazy low prices, because stocks often trade at truly foolish prices, both high and low. Efficient market exists only in textbooks. And what's great about what's happening in the market right now is that you get great companies selling at really foolish prices, at discounts. Not all of them. Like in my opinion, I think Alibaba, for example, is still extremely undervalued. They recently announced great earnings. Their profits went up 65%, but the share price went down. Why? It doesn't make sense. Absolutely doesn't make sense. Because in a short term, the market is not driven by logic. It's not driven by fundamentals. In the short term, the market is driven by purely emotions. So if you're wondering, is Alibaba making more money? Is the business actually increasing in value? Yes. But the share price goes down. Why? Because of emotions regarding the geopolitical tensions, right? The balloon incident, and then US accusing China of arming Russia. So it's all the emotions that's causing the price to go down. So if you own Alibaba shares and you're looking at the business and the business is doing well, but the price goes down, should you be upset? No, you shouldn't be upset because it's a great company, right? And you've got no control over where the price goes. So you've got two choices, right? Either you just hold it because eventually it's going to go a lot higher, or if you don't have a full position, you can keep adding to that position. Another example is Adobe, right? I own Adobe as well. And Adobe, about a couple of months ago, they announced that they were buying Figma for $20 billion, and the market went crazy. They said, oh, you're overpaying for Figma, and Adobe went down kind of like, was it 20, 30%, right? And I bought shares because I thought, my God, great company, more undervalued. And now that the US Justice Department is suing the deal and saying that you can't buy Figma, the share price went down again. So you can see that in the short term, the market can be purely irrational. But look at the underlying business. Is Adobe making more money? Yes. Is the value of the business going up? Yes. So if the share price goes down, no point getting upset. Buy more shares of a great company because over time, you will do really, really well. So the key is to understand. Let me kind of like draw this out for you. I don't have my drawing tools. I'm in a hotel, but let me do my best to kind of like freehand draw this. Many investors are often confused. If I buy a stock and the share price goes down, did I make a mistake? And what should I do? Should I cut loss or should I buy more? It all depends on the actual underlying business and whether you're investing or you're doing a short-term swing trade. You've got to be very clear about that, right? So for example, if you look at a business and you find that the underlying business itself is increasing in value, right? So this green line represents the intrinsic value of the business. So again, companies like Adobe, like Google, Alphabet, like even Alibaba, they are increasing in value because they are making more money. It's a fact. It's in the financial statements, right? But a company can increase in value over time, but the share price doesn't go up with the business value exactly. In the short term, the share price may not go up every day, every week, every month, or even every year because it's driven by short-term emotions. So when there's hype, when there's excitement, the price can go up. Whoa! The red represents the market price. But when there's panic, when there's some emotional event, the price can go down below the intrinsic value. So what happens is the price gets overpriced, underpriced. It swings from extremes, right? And as long as the business is going up in value and the share price, the red line, goes below the intrinsic value, these are times that you want to add shares. Now again, does it mean that after you buy, you go up straight away? Of course not. You can buy over here and guess what? It could still go down. You can't always buy at the bottom. But as long as you buy when it's below the intrinsic value, over time, as the value increases, you will definitely make money. All right. So you got to look at the underlying business. Is the free cash flow per share increasing? Is the sales per share increasing? If it is, then no worries if the price goes down in the short term because it is a temporary thing that you can take advantage of but not be influenced by in terms of an investor. Now, at the same time, if the underlying business is deteriorating, again, in the case of Intel, for example, in my opinion, the underlying business is deteriorating because in the past, Intel, the sales were increasing, the free cash flow was increasing, but now because they've lost their competitive advantage to AMD, to Nvidia, to TSMC, their sales have been going down. Their profits have been going down. Their free cash flow has been going down. And it doesn't look like it's a short-term phenomenon. It looks like it's a secular structural issue that they're facing. So when the value goes down and the share price in red goes down, Again, even though it looks cheap, it's selling below the intrinsic value. Would I buy this? No, I won't, because the underlying business is deteriorating. And sure, you buy it here, it can jump up in a short term, for example, but over time, it's not really going to go up anymore. So again, it's all about looking at the business to determine whether you made a good investment and not the short-term share price movement. Next, he talks about his secret sauce. So the secret sauce, again, is in buying the best companies in the world, companies that have got a sustainable competitive advantage, and many of them are what is known as brand monopolies. They dominate their niche. American Express in traveler's checks, credit cards, Coca-Cola in soft drinks. Now, what's interesting is this. He says that in 1994, that's right, 1994, Berkshire completed its 7-year purchase of 400 million shares of Coca-Cola that we now own. Now, let that sink in. How many years did it take for him to acquire the entire stake in Coca-Cola? 7 years. And that's one thing that I teach my students all the time, that investing is not a sprint. It's not put everything onto one stock right now. Investing is a marathon. So for example, I invest in Amazon, I invest in Alphabet, among many companies, Microsoft. Do I buy all the shares I want to buy right now? No. I buy consistently year after year after year. I slowly dollar cost average in my investments over time in tranches. And of course, I buy as long as it's undervalued. And when I look at the technical charts, they retrace to optimal support levels. So again, understand that when you invest in a company, you don't buy all at one go. You buy slowly over time, right? So you want to buy consistently over many, many years. It's a marathon, it's not a sprint. And then he bought American Express, same story. Took him many, many years to build his position. So overall, he invested about $1.3 billion in Coca-Cola and invested $1.3 billion in American Express. Today, his Coke investment is worth $25 billion. And his American Express is worth $22 billion. Each of them are roughly 5% of his portfolio weight in Berkshire. So think about it. He bought those two businesses in 1994. That's like 28 years. Now, am I saying that you got to hold a company for 28 years? No. But you got to give it some time for your investments to compound. Now, this is one thing that I really learned from Buffett. I started investing at the age of 17 years old. I'm now 49 years old, so now it's been like 31 years. And in my early years, like most people, I tended to jump in and out of the markets. I get into a stock, I thought it went up enough, let me sell before it goes down, and then I would buy it back, and I jumped in and out of my stocks in the past. And I made money. But when I look back, I realized that if I just held on to those great companies that I bought years ago, like I bought Alphabet years ago, Amazon years ago, I bought Microsoft years ago, if I just held on for the last 31 years since I've been investing, instead of jumping in and out, guess what? Today, I'll probably be 5 to 10 times richer than I am today. So that's one thing to understand, that you gotta have the patience to hold great companies and give them time to compound into huge amounts of money. Now, people often ask me, then when do you sell? In that case, if you hold for the long term, when do you sell? The answer is you sell when you need the money. It's as simple as that. If you need to buy a new car, sure, sell your shares to buy the new car. If you need to buy a new house, renovate the house, sell your shares to buy the house. So in other words, as long as you don't need the money, keep it, let it compound. Don't meddle with it, don't intervene with it. But sure, sell it if you need the cash to purchase something. Then obviously, then you sell, right? And why is it many people are underperforming the market? Very simple, because overstimulation from the media, like Jim Cramer, buy, sell. Overstimulation from social media, and now the fact that brokerages are offering zero commissions, it encourages people to buy and sell more regularly, right? And you can see that over the years, the holding period for stocks has gone down. That now the average investor holds a share of a stock for 5 months. That's the average holding period. So I mean, if you think about it, that's why it's really hard for most people to be able to build their wealth, because, they don't stay long enough into an investment to let it compound. You can see that since 1992, the average return of the S&P 500 is 10.7%, but the average investor that jumps in and out of the market has underperformed the overall market. The next thing Buffett emphasizes is the importance of share buybacks, that you want to invest in companies that buy back their shares. So he said, at Berkshire, we directly increase your interest, the shareholders' interest in our unique collection of businesses by repurchasing 1.2% of the company's outstanding shares. At Apple and American Express, repurchases increase Berkshire's ownership a bit without any cost to us. The math isn't complicated. When the share count goes down, when the number of shares decreases because of share buybacks, your interest in our many businesses goes up. Every small bit helps if repurchases are made at value accretive prices. So what does this mean? This means that you want to invest in businesses that, number one, generate a lot of free cash flow. When a company generates free cash flow, they are able to pay dividends or they're able to buy back shares. Now, between the two, we prefer companies to buy back shares, because when you pay dividends, shareholders have to pay tax on those dividends. But when companies buy back shares, they are returning capital to shareholders without the shareholders being taxed on that return of capital. All right, and that increases your stakes in the businesses. But as long as companies buy back shares when they are value accretive, what does that mean? That means you only want a business to buy back shares if, number one, the business is doing well. Their sales are going up, their profits are going up. But if the company is not doing well, the company's sales are going down, profits are going down, then they shouldn't be buying back shares. They should be using their cash to improve their business. That's number one. Number two, a company should only buy back shares if their share price is fundamentally undervalued. So, for example, Alibaba has been buying back shares. Company's undervalued, company is growing, great move. Meta has been buying back shares. Meta is undervalued, great move. Alphabet, Amazon buying back shares. Their share price is undervalued, great move. But if their share price was overvalued, then that's a bad move. So I love it that these companies are buying back shares, and so should you, because by doing that, it's increasing your stake in the businesses over time. Next, Buffett goes on to say that I've been investing for 80 years. And I've yet to see a time when it made sense to make a long-term bet against America. And I doubt very much that any reader of this letter will have a different experience in the future. So one thing to understand is this, America's not perfect, right? A lot of problems with politics and all kinds of things. But at the end of the day, if you look at the US market, if you look at the companies that make up the US market, the S&P 500, the Dow 30, these are companies that don't just sell to the US market. They sell to people all around the world. So whether you're from Egypt, you're from Singapore, from Malaysia, from the Philippines, you drink Coca-Cola, you eat at McDonald's, you use Visa, you use MasterCard. And like it or not, the US market has given the highest returns over the long run with the lowest volatility. And no other market comes close. Not China, not India, not Japan, nothing comes close to the US market. Now, some people say, but Adam, if you look at the Indian market, India has been outperforming the S&P 500. Not if you account for currency loss. If you account for currency loss of the Indian rupee to the US dollar, you are still gaining more investing in the US markets compared to the Indian markets because of the currency loss of the Indian rupee, right? So nothing comes close. And again, this chart summarizes everything. If you take a look at the last 123 years of the US stock market, represented by the Dow Jones Index, the oldest index in the world, despite 2 world wars, despite a Great Depression, despite dot-com crash, US financial crisis, European sovereign debt crisis, a COVID-19 pandemic, and the US-China trade war, and the US debt ceiling, and all kinds of problems, there's always something to worry about in the world. But despite all these problems, guess what? The market always goes higher in the long run. And that's why I keep saying that if you are constantly bullish like me, sure, Once in a while, you may look like an idiot when the market goes down in the short term for a few months or 1 or 2 years. But in the long run, as a bull, you always win. But if you are someone who's always bearish, always negative, yeah, once in a while, you may feel very smart when the market goes down for a few months or for even a year or 2 years. But in the long run, you will always lose out, because in the long run, corporate earnings always go up. Corporate earnings always double every 9 years. It's a fact. And share prices, because of corporate earnings doubling, because of inflation, because of population and wage growth, will always be higher over time. So it pays to be a long-term bull in the market. Finally, Buffett pays tribute to his long-term partner, Charlie Munger, who at 99 years old is sharper and more logical than many people in their 20s and 30s. So something that you truly got to respect about Charlie Munger. And these are some of his quotes, and I just highlighted some of it, right? Where, Munger keeps saying, a great company keeps working after you are not working, and a mediocre company won't do that. So remember that time is the friend of the great company. If you buy a great business, time is your friend. The longer you're patient, the more you're going to be rewarded. But time is the enemy of the mediocre business. So only buy great companies. Warren and I don't focus on the froth of the market. We seek out good long-term investments and stubbornly hold them for a long time. You got, time in the markets is better than trying to time the markets perfectly all the time. Ben Graham said, day to day, the stock market is a voting machine. Sometimes a lousy company, the price can go up simply because people are excited. It's a voting machine. But in the long run, the market is a weighing machine. Then in the long term, fundamentals matter. In the long run, earnings and free cash flow matters. That's why I keep saying that if you buy companies that are making money and making more money year after year, you have zero worries. Over time, you're going to be extremely wealthy. There's no such thing as a 100% sure thing when it comes to investing. And that's why you have to diversify. Some people take Buffett's words out of context, that diversification is bad, you got to put everything to one. No, Buffett diversifies himself. He's got over 40 publicly traded companies in his portfolio. But that's known as concentrated diversification. Granted, it's not equally diversified. Like Apple takes up like 40% of the portfolio, but he still is diversified among many banks and energy companies and so on and so forth. So it is important to still have some kind of diversification, all right? Because there's no sure thing. In the short term, shit can happen to a company. So you got to diversify across different sectors and avoid using leverage, because ultimately the one thing that can kill you is leverage. That even if you're right, but if you over leverage, you can get wiped out by short-term fluctuations and not be there when the market recovers. So this was a quick video I did. I hope it helped. I thought something I'd like to share because it's a letter that has inspired me for many, many years, and I do hope that you take away these time-tested lessons and use it in today's context in your investments. So I'll see you guys back in Singapore when I'm back in a couple of days. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com, where you're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.